Welcome back to Tesla Daily News Podcast. Today is February 20th, 2026. In the next few minutes, we're breaking down the Tesla developments that matter most for Tesla holders, pricing moves that hit margins, autonomy and robotaxi progress and pushback, labor risk in Europe, and a couple of under-the-radar infrastructure and compliance stories investors should not ignore. First up, Tesla just cut the Cybertruck Cyberbeast price, and the market should read this as a demand signal. Here's the hook. The highest-end Cybertruck trim just got a sudden price drop of about $15,000, landing at roughly $99,990 in the United States. Context matters. Cybertruck was supposed to be a high-SP halo product that supports gross margin dollars even if volumes start smaller. When Tesla cuts price on a flagship trim, it usually means one of two things. Either Tesla is attacking the order funnel to keep factory utilization up, or it's repositioning against competition and consumer price sensitivity. Details. Turkish press citing Tesla's updated online pricing frames it as a clear, immediate reduction. The number investors should anchor to is that $15,000 cut. Impact. Price cuts can lift unit demand, but they compress automotive gross margin unless Tesla simultaneously reduces build cost. Cybertruck's manufacturing learning curve is still developing, and every move like this increases pressure on the narrative that Tesla can expand margins in the near term. Takeaway. Watch for two things in coming weeks. Whether delivery lead times tighten, which would suggest demand reaccelerates, and whether Tesla introduces offsetting options, financing incentives, or cost-down updates that preserve profitability. Second story. Robotaxi and autonomy are moving fast in messaging, but slower in permitting, and that gap is stock moving. Hook. Reports out of California say Tesla has not meaningfully advanced on getting robotaxi approval there, even though the company previously floated plans to launch. Context. Tesla's valuation has always carried a software and autonomy premium. Robotaxi revenue is a high upside story, but it's also the most regulated pathway Tesla is pursuing. Investors are constantly repricing Tesla based on whether autonomy is a near-term cash flow driver or a long-dated option. Details. The report points to the key bottleneck: regulatory clearance. And it contrasts Tesla's position with Waymo's operational footprint, underscoring that real-world driverless deployments require not just tech, but approvals, operating frameworks, and safety reporting. Impact. If regulatory progress stalls, analysts will tend to push out robotaxi timelines and reduce near-term revenue assumptions. That can compress multiple expansion, even if vehicle deliveries hold steady. Takeaway. Autonomy is not just a model capability issue. It's a jurisdiction-by-jurisdiction business development problem. Watch California filings and any official DMV or CPUC actions, not just product demos. Third story. Tesla's own safety math around Robotaxi is being debated publicly, and that can affect sentiment and regulators. Hook. Fortune highlights a claim that, based on Tesla's reported data, Tesla Robotaxis are multiple times worse than humans at driving, with additional details redacted. Context. For investors, the headline risk here is twofold. 1. It can feed negative public narratives and slow regulatory momentum. 2. It can increase litigation and compliance costs if agencies broaden scrutiny. Details. The story points to comparisons against human driving benchmarks and raises concerns about limited transparency. Impact. Even if the underlying numbers are disputed, this kind of framing can influence both policymakers and mainstream investor sentiment, which matters when Tesla is priced on future autonomy cash flows. Takeaway. Demand more clarity on definitions. What counts as a disengagement? What is the operational domain? What miles are being compared? Autonomy valuation depends on credible, comparable metrics. Fourth story. Tesla is talking up Europe autonomy and bigger factory ambitions, but it's still gated by authority cooperation. Hook. A report from Next Big Future summarizes an Elon Musk interview at Giga Berlin, including a claim about full self-driving regulatory approval in Europe starting with the Netherlands around March 20th, 2026, plus discussion of Cybercab, Optimus, and even expanding Berlin into the largest factory in Europe if authorities cooperate. Context. Europe is strategically important because it's both a large EV market and a tough regulatory environment. If Tesla can win approvals there, it strengthens the global FSD story. Details. The notable data point is the specific date reference, March 20th, tied to the Netherlands, and the conditional language around expanding Berlin. Impact. If credible, a concrete European approval timeline can lift near-term autonomy optimism and analyst models. But because it's conditional and not yet confirmed by regulators in these articles, it also carries disappointment risk. Takeaway. Treat this as an upside catalyst with verification required. If you trade Tesla around autonomy headlines, separate interview claims from published regulatory decisions. Fifth story, labor relations at Giga Berlin are turning into a real operational and reputational variable. Hook. Germany's IG Metall is publicly warning Musk to refrain from what it calls threats ahead of a works council election at Grünheide, and multiple outlets describe the vote as a high-stakes direction-setting moment. Context. Tesla's Berlin plant is its only vehicle factory in Europe. Anything that raises the probability of disruption, higher labor cost, or stricter work rules can impact output, costs, and expansion speed. Details. Reports describe a bitter conflict and heightened rhetoric ahead of the election. Separately, Die Zeit reports Tesla and IG Metall reached a court settlement over a dispute involving an alleged recording of a works council meeting. Impact. Best case, the settlement reduces immediate legal noise. Worst case, the broader labor conflict could lead to a less flexible operating environment, and that matters for ramping new programs and hitting cost targets in Europe. Takeaway. Investors should watch for signals of production interruptions, absenteeism disputes, or wage and scheduling changes. Berlin doesn't have to stop production to become a margin story. Sixth story. Tesla's environmental compliance in Texas is drawing scrutiny, and that's the kind of risk that can surprise the stock. Hook. Local officials in South Texas say they discovered Tesla has been discharging treated wastewater from its lithium refinery into a drainage ditch without notifying the district. Context. Tesla is trying to build vertically integrated battery material capacity. But industrial projects come with permitting, reporting, and community relations risk. When local authorities say they did not know what an operation was doing, that can escalate into fines, mandated process changes, or slowed expansion. Details. The key point is not the chemistry of treated wastewater, it's the alleged lack of notification and the potential compliance gap. Impact. Most of the time this is not a quarter-ruining event, but it can create headline drag, add costs, and slow the timeline for a facility that was meant to support long-term supply chain resilience. Takeaway. Tesla's manufacturing advantage depends on execution and trust with regulators. Watch for any formal enforcement action or required remediation. Seventh story. Tesla is quietly expanding charging and selling higher-margin accessories, and that supports the ecosystem narrative. Hook. Tesla opened a new supercharger site in Naha, Okinawa, which is Japan's 145th location and the first in Okinawa Prefecture. Context. Charging density reduces adoption friction and supports resale values, which helps demand. It also strengthens Tesla's competitive moat as more automakers use compatible charging standards. Details. The Naha location is positioned near major routes and the airport area, which makes it useful for locals and travelers. Impact. On its own, one site doesn't move the stock. But steady network expansion supports Tesla's long-term thesis, ecosystem, convenience, and brand stickiness. Takeaway. Investors should track charging build-out as a compounding advantage, even when quarterly headlines focus on vehicle pricing. And a quick bonus item on consumer charging. Tesla is now selling a tall pedestal for its Gen 3 wall connector for about $900. Hook. It's a simple hardware add-on, but it hints at Tesla continuing to monetize the at-home charging experience. Context and impact. Accessories tend to be higher margin than vehicles, and they reinforce the Tesla ecosystem. It's small dollars, but recurring product breadth matters. Takeaway. Watch for more bundled home energy and charging offerings that could lift average revenue per customer over time. Now, the broader competitive frame to end on. Multiple reports highlight brutal competition among Chinese EV makers, with BYD described as surpassing Tesla in global EV leadership, while price wars and shrinking subsidies squeeze margins. For Tesla investors, this matters because it reinforces why Tesla keeps using price as a lever. The downside is margin pressure. The upside is Tesla's cost structure and software attach rate may still be better positioned than many peers. That's it for February 28th. Today's themes were clear: price cuts versus margins, autonomy ambition versus regulatory reality, Europe labor risk at Berlin, and compliance and infrastructure headlines that can quietly shape execution. Tomorrow, watch for any official regulatory updates on FSD in Europe, any formal action on the Texas wastewater story, and any new data points on Cybertruck demand after the Cyberbeast price move. If you found this useful, subscribe to Tesla Daily News Podcast and follow us for daily, investor-focused updates on what's moving Tesla's business and TSLA stock.